Our next guest warns the summer correction is already underway. Mike Wilson is the chief U.S. equity strategist at Morgan Stanley. Mike, great to have you with us. So you think we're about a month plus in to this correction you're calling for?
Yeah, I mean, it's not that it's a major correction. I mean, but it started on June 8th. I think everybody knows that the market peaked there, S&P 500. We had a big pullback in June. This is when the cyclical/value stocks really underperformed, and for good reason. Case count went up. There's concerns about Democratic sweep, other election concerns, all kinds of things that kind of weighed on the beta trade. And then we had this big rally back the last couple of weeks where we basically touched the old highs yesterday and got rejected. So I think we're having a classic sort of zigzag correction this summer. Carter can opine on that. I think it's not done yet. I think all those concerns I just mentioned are still lingering in the background. The COVID cases are still rising. We have an earnings season that's going to be somewhat messy. Today the banks put up good numbers generally speaking, except maybe for Wells, and the stocks didn't really do anything, right? So we have to consolidate some more. The question that you all were asking a minute ago is the right one, though. Is there something more going on under the surface here? And I think it's been going on the whole time. So people can talk about the growth stocks. They've done great. They have done great. I agree with that. We like growth stocks. But the other side of the barbell now is clearly cyclicals, okay? Those stocks have done extraordinarily well since March 23rd, which is when the market bottomed. You can't look at this from the year to date. Why? Because we're in a recession, and you have a new starting point. And the leadership is clearly cyclicals plus growth. The loser is defensives and sort of the really high-quality stocks that were working last year because you're at the end of a cycle. So I definitely think that the cyclicals can outperform growth even from here because they got more operating leverage, and their expectations are still low. And we're bullish on the recovery, and we think this is a pause. This is not the end of the bull market. It's the beginning of the bull market. It's just we got to such a fast start. We have to have a bit of a correction here.
What makes you so bullish about the recovery, given the surge in cases in California, basically reinstituting the lockdown measures that they had in March?
Yeah, I mean, look, at the end of the day, we don't think it's going to result in a national lockdown. Is there going to be a slowing of the reopening process? Yes, we're already seeing that. But generally speaking, the reopening will continue. And by the way, good parts of the country, including the New York area, are doing well with the reopening, slowly. And I think, we're learning as we go. And my guess is we're going to continue to make progress on that. Obviously, vaccines are part of that discussion as well. And I just think the economic impact of the virus itself is behind us. The market's looking forward. And look, stocks are long-duration assets. 2020 is a write-off year. 2021 is going to be a much better year, and it will be really better, much better, if you get a vaccine earlier than people expect. And that's kind of our view, is that we're just going to climb the wall of worry on the virus.
You are expecting new highs after the election, so I'm wondering, in that call, what does the leadership of the market look like to get to those new highs?
Yeah, I think it's what I was just talking about a minute ago, Melissa, which is it's going to be a combination of some of the former leaders, and I would call that growth stocks at a reasonable price. Guy mentioned it earlier, ridiculous performance. Well, some of the valuations are ridiculous on some of these stocks. It's unarguable. But there are some wonderful growth companies that are trading at fine valuations. They need to grow into those, and they will. So that's on one side, and so some of those stocks will continue to lead that have been leading. And then you're going to get this new cohort of the cyclical stocks that have been left behind, not just for the last year or two, but for the better part of a decade, whether that be the banks, whether that be some of the materials names, maybe some of the energy stocks, industrials. And a lot of that could be driven by an election outcome where you get infrastructure spend, which I think there is bipartisan support, and there's going to be more fiscal. We know that already, probably coming out next month.
Mike, we got to go. Thanks so much for phoning in. Always good to hear from you.
Thank you, Melissa.
Mike Wilson of Morgan Stanley. Bonawyn, you agree with, this notion of a V-shaped recovery and being positioned in cyclicals in preparation for it?
I'm going to hold back on V, more U or Nike swoosh type of recovery. Listen, at the end of the day, as we've said, the value play or values underperforming has kind of been a trend for a while, and there's been quite a bit of people pounding the table saying that, listen, there needs to be this rotation out of mega cap tech into value, into cyclicals. But I'll tell you this, until there's a bit more clear-cut answer to this COVID crisis, until the volatility of the market calms down, people are going to continue to look for fortress-like balance sheet and free cash flow generation. And I stand by that. So I think it'll be a bit more elongated. You've heard the banks come out and say similar things today as well.
By the way, we are expecting President Trump to speak in the Rose Garden shortly. He's expected to make some comments on China. So as soon as he comes up, you see a live picture there, we will go to it. But Guy, back to the markets in the meantime. What do you like of what Mike Wilson said, or maybe nothing?
No, listen, Mike Wilson does extraordinarily thoughtful work, without question. When he says things, I absolutely listen. There's that Led Zeppelin song, I'm sure you're familiar with it, Mel. It's off their final studio album, In Through the Outdoor, All of My Love. And one of the lines is, one voice is clear above the din, and Mike is one of those voices. So I respect what he's saying. I just don't necessarily agree with that bullish a thesis. I do think the market is expensive, and I absolutely do think the reversals we saw yesterday technically did a lot of damage. Now, today sort of mitigates that, I understand, but there are a lot of things that happened yesterday that I think, to your earlier point, we're going to be talking about in the weeks and months to come.
Do you see new highs, Carter, in the markets after the elections?
I think that's a stretch. One of the things about a V, the market is saying V, but the data as of now is not. If you just looked at a couple of things, consumer confidence in the March-April period dropped 30 points. It's up 6 points. Industrial production dropped 16, 17%. It's up 1.5 from the low. Or EPS revisions, they were down some 25% in March and April. Now maybe they're up 3 or 4. We don't have that in the data yet. Certainly the news out of the banks today in terms of almost record provisions, that's not the kind of thing that happens if you're really all clear.
And of course, the big wild card, or one wild card to factor into the markets, is the heightened tensions between the U.S. and China. And that's why we are awaiting President Trump's comments regarding China, Dan. It's not just trade. It's also Mike Pompeo yesterday saying that China did not have a right to claim resources in the South China Sea, which, of course, China says it does have a right to do so. So you have this ongoing back and forth rhetoric, which all contribute to heightened tensions.
Yeah, listen, you guys have heard me say this before. I've thought this for a long time now. I don't think the Trump administration's policy towards China, while I think that it's bipartisan that we all agree that we need to take them on, we are very much in a Cold War with them. And on a tech front, we're in a bit of a hot war. And there's lots of examples that I can point to. So, increased tension with China just means headwinds to global growth. We know that we're seeing deglobalization. We're seeing it for probably pretty decent reasons right now, like reshoring some of our manufacturing, that sort of stuff. But if this sort of sanction tit for tat results in a rollback of some of the tariffs or actually put forward of more tariffs, then we know who pays for that. U.S. consumers pay for that, manufacturers pay for that, farmers pay for that. And I just don't think at this point where we are with our economy, it makes a whole heck of a lot of sense. And I just want to make one other point. I think, again, looking at the state of the recovery through the lens of the stock market is a big mistake right here. If you just look at what has happened in the economy just in the last 4 months, we had that March-April period where it looked disastrous, and then we had that May-June period where it looked less bad. Our economy is probably pretty scarred for the next couple years or so. We are going to have structural unemployment. We are going to have the big are going to continue to get bigger here. So to me, I just think that, when we think about the back half of this year, it's not going to look like a V. I think what Bonawyn said, it's a U. That would be optimistic. It looks maybe more like a swoosh. But I suspect, after the financial crisis, remember we heard all about that double dip? We may get a double dip. You know why? We front end loaded all of that fiscal, all of that monetary stimulus. At some point, someone's going to say, hey, listen, enough is enough. We can't continue just to throw trillions at this without making structural changes.